Tell me about this.
Okay.
Yes, come on.
Richard. Okay, I think right now it's a very hard problem for the global central banks because they are kind of working on a fine line to keep the balance. On one hand, they don't want to hike too fast to dampen the global expansion because the U.S. unemployment rate is at a very saturated level already, and on the other hand, they don't want to keep the monetary policy too accommodative, to create too much excess in a real economy. So I think my base case scenario is still that the global central banks will still keep the fine balance, especially they will be biased toward printing more money to keep the monetary policy accommodative in the next year. That is a risk, but that's not my base case scenario. I think another risk you gotta watch on is actually the possibly the policy mistake by the Chinese government. They are trying to clamp down on the kind of the over leverage the financial system, especially the shadow banks. However, when you drain the liquidity from the system, it's very hard to make it the direction very accurate because the liquidity will always find the easiest way and to get out from the system. Yep. So that will be put a downward pressure on the stock market and even the real economy.
Let's just look at Japan. Mm-hmm. You could argue it's the most accommodative monetary policy of them all. You could argue that. Right. You could, on the other hand, also listen to Mikio Kamada from LGT Capital, who was on just about an hour and a half ago, who said that he thought it was too tight. And he wants to have the shorter end brought down even more, such that we can steepen the yield curve even more. What are your thoughts on that, putting the short end even further into negative terrain?
Yeah, actually in Japan, you mean Japan, right?
Yes.
JGB. I think Japan, they are still far away from their target inflation rate at 2%. So, and the Governor Kurata mentioned several times publicly that he will keep printing the money at the current pace. However, I think if you look at the Japanese JGB real yield, okay, you need to take into consideration of the negative basis, the cross-currency basis. I think not everybody in this market really understand the cross-currency basis. That is related to actually also related to the tax reform undergoing in the U.S. because the tax reform aims to repatriate the overseas capital that will arouse a tighter overseas U.S. dollar market, and that will increase the negative basis either in Japan or in Europe. And that will make the Japanese assets and the European assets actually a higher yielding currency than the U.S. dollar, than the U.S. currencies, than the U.S. assets.
Is that the basis of why you believe that the yen will appreciate? It, of course, has room to appreciate, but will it? The Bank of Japan will be trying to make damn sure that it doesn't.
Right. That is the technical reason why I believe the Japanese yen will further appreciate. But from the fundamental point of view, the Japanese yen is trading at a very, very cheap real FX rate. It's trading it's trading at a 30% discount in real terms to the level before the Plaza Agreement in 1987. So it's one of the most undervalued currencies in this world right now. I mean, from either.
But we were looking at it being what, 75, 76, even at one stage, 77.
At that time, that's around the level, yeah, of the levels before the Plaza Agreement.
No, I'm talking about before Abenomics. That's what we were talking about.
Before, yeah. At that time, I think at that level, sounds more, the valuation is more fair than the current level. Right. Yeah, I think Japanese yen has big room to appreciate.
Okay, so tell me, where's the juice if you look everywhere if we're talking about real yield? And if you just want to be a yield player, where do you go for that? It doesn't necessarily have to be fixed income, or does it, in your view? It could be about dividends. It could be about dividend yields. Yeah,
right. I think the top pick for me right now is actually the emerging market, the local currency assets, including the local currency equities and also the bonds. For the emerging market dollar bond, they are trading at a pretty rich level, around the upper bound of the fair valuation. But for the local currency bonds, for many countries, emerging market countries, they are going through a profound reform to bring down the structural inflation, okay, in order to lower the social funding cost. For those countries like Argentina is doing that, Brazil, Russia, and Indonesia.
You mentioned 2 out of those 3 countries have defaulted on their bonds before, though. That's the thing.
Right. But that is the history, right? They changed the regime already, and the current regime is endeavor to.
In Argentina, you're talking about, yes.
Right, Argentina and Brazil.
Okay.
Yeah.
But, let's also just take a look at the local currency bonds when they are issued. It's also a bet on the dollar, isn't it? And how do you hedge yourself with that?
If I'm bullish on those currencies, I'm bullish on those economies, I will just keep my exposure open for the FX. And I believe the U.S. dollar will continue to depreciate, to weaken against either emerging market currencies or the other, DM currencies like euro and the Japanese yen, because U.S. dollar, the U.S. economy is peaking off. Okay, it's very close to its peak of the cycle in terms of the growth rate.
But then again, with rate hikes next year, they're priced in, are they not? I mean, at least 2 or 3 are. If we get 4, of course, that's not been yet.
Right. It's priced in. But the market is trying to price in more, a monetary tightening by the ECB and the JGB going forward. So I think in the end, if you look at the FX rate, in the end, you got to look at the IRR of the underlying currencies and the underlying economies. So right now, I think the least attractive currency is actually the U.S. dollar.
The least attractive right now.
Right.
Okay,
right.
But you're looking at EM, in particular, any one you'd like to single out here?
Emerging markets? For emerging market
yes.
space? I think, Brazil, Russia, Argentina.
You mentioned those, yes. Okay, and we'd be looking here at sovereign, not necessarily corporate.
Not necessarily corporates, yeah. I will just focus on the, the quasi-sovereign corporates.